Welcome everyone to another episode of Frank Finance, where you can get your honest financial information and your questions answered. Today, we're going to talk about how much does it actually require in your investment portfolio so that you can retire on dividends alone and never have that pool run dry. Well, before we get into it, we really need to talk about and understand the different forms of income and build up that walk so you really understand the importance of it. So, first and foremost, you have active income, which is probably what you're receiving today if you're getting paid hourly or a salary. The reason why that's important to understand is the tax on active income is going to be higher than that on passive income, which is what investing is. So passive income is where you would give someone else, or you buy stocks or bonds or crypto or even rentals, and it receives funds back to you over time, or the value of it goes up over time. That actually has a favorable tax benefit, which is why it's referred to as passive income, because you're not actively engaged in it. So when we think about stocks and bonds that pay dividends, and we think about those type of stocks that we hear called growth stocks, it's really important to understand the difference. And here's why. Growth stocks, like the Teslas of the world, will actually reinvest their capital back in the company to grow. That's going to create what's called an increased in perceived value, hopefully. Now, if you have a stock that pays dividends out, those are typically your value stocks. Now, what they do is they're at a mature state, so they can actually give their shareholders back dividends. Why is this important? If you have a growth stock and you don't sell it and it goes up in value, that's called an unrealized gain. That's a non-taxable event. If you have a value stock and it pays you dividends, that is actually considered a realized gain and a taxable event. All right, so let's talk about taxes for a second. When you think about your active income as a family today, let's say you're married, filing jointly, and you have $100,000 is what you guys make. Now, if you think about what is that after taxes, 15% marginal, 7% for FICA, and ignoring state taxes, that drops you down below $80,000 that you would have in your pocket to spend. From a passive income perspective, if it's below $85,000 in income, you actually pay no federal and you don't pay FICA. So think about this for a second. That means that when we build up how much do you actually need for you to retire, you actually need about 15-ish% less than what you get paid today. In this scenario that I just gave you, those that have $85,000 in dividend income actually make more than a couple that has $100,000. So let's get into the numbers. If today, and I'm using this as a benchmark, $100,000 might be high because you think of the median household income today, it's somewhere between $50,000 and $70,000 depending on where you actually live in the United States. So let's just use and benchmark $80,000 of dividend income as what you need to retire. Well, what would that require? You would actually need $2.8 million put away if you're in those type of stocks like VYM and BND that pay nearly 2 to 3% in dividend income. So basically, you can take what you need, call it $80,000 a year, and divide it by the percent in dividends that you need, which I'm using 3%. That gets you to $2.8 million. You're like, hold up, I invest in REITs, AT&T, Chevron, Exxon. They pay me 6% or more. Fine. So at a 6% dividend, if you were to keep it in those type of stocks or funds, you would actually be needing about $1.4 million in your nest egg. So now thinking about this from a broad perspective, if you were to invest in dividend stocks today and start from scratch, and you were to invest it in those type of funds that give you 3%, you would nearly need to put away $5,500 a month for 30 years just to get up to $2.8 million. And that's assuming you reinvest the dividends. Well, I'm gonna go into those type of AT&T stocks or the 6% dividends per year. Then it's a little bit more manageable at about $17,000 a year or $1,500 a month. That would get you up to that $1.4 million that I said you need aside in order to get $80,000 a year in dividends. So this is something to think about, how much you'd actually have to put away from scratch just to solely invest in dividend style stocks and be able to have a never-ending cash flow, assuming you have no other income from Social Security, 401k, rentals. And this is why it's so important to understand why people put more funds into growth stocks earlier in their career, and they look at how much do you need that goal fund to be at the end of retirement. So if you want to retire in 20 years, and you put your funds away into a dividend stock that pays 3%, whatever the number is that you need, divide it by the percent that you would need from dividends to get there. So in my instance, $80,000 is what I am looking for as our family. I would divide it by 3%, and then that gets me to my target fund. That's what I need to have set aside in order to have cash flow forever. The next series that are going to come are going to be talking about other things that you can do to try to reduce how much you need to put away, because thinking about putting $1.4 million or $2.8 million away, for many people, and even myself, that's a daunting task, and I want to retire earlier than 30 years from today. Hopefully this video has been helpful. Hopefully this video opens up your eyes to how much you actually need put away for dividend stocks, and hopefully you have a better strategy than just dumping all your money in dividend stocks, because it will take you way longer than investing in growth stocks and having another branch or portfolio to help you get to that nest egg. That doesn't mean once you get closer to retirement you shouldn't start shifting these funds over into those type of stocks. And the reason why that's important and why a lot of strategies is to move to dividend stocks or bonds late in their investment time is because they are less impacted by interest rates rising, by economic downturn. They are a little bit more stable, where growth stocks are going to just plummet in bad times. And for anyone that's investing right now, they don't have to look very far to watch the roller coaster that growth stocks are going through. And for everyone that's seen my video that I put up a couple weeks ago where I've gone into index funds, I actually don't have a lot of volatility anymore. In fact, it's very minimal, which is really nice for me. It's less stressful, etc. But I understand that it's not going to get me the growth at the speed that I'm hoping for. If you enjoyed this, please like, subscribe, comment. Also, tune in to our Twitch chat at 9 p.m. Central on Sunday nights, and we can have live discussions on any of these type of topics. Till next time, have a great day. Bye.